with David Craddock, who today will be talking to us with some insights into share valuation for employee share schemes, using some dynamic case studies to illustrate his points. This is part of a series that David has been presenting for us for some months now, and to some extent it comes as a follow-up to an earlier webinar where we talked about the share valuations. We had loads and loads of questions from the audience, and we concluded that maybe a webinar that covers valuations through some case studies would help to illustrate the points and address some of those many questions. So we hope that we're going to be able to achieve that. There will be plenty of time for questions afterwards as well. So here's the agenda. We have, in theory, 5 minutes of my introduction, although I hope to be taking up less than 5 minutes of your time. David will speak for about 25 minutes, and then we hope to have 15 minutes for questions and comments and some closing remarks. If you do want to ask questions, please use the GoToWebinar questions buttons within GoToWebinar. We love to hear from you, and we love to hear from you any way you like to communicate with us, but during the webinar we only see the questions that come in through the GoToWebinar system. We're sort of locked into to what I think these days we're calling a bubble. So if you want to communicate with us during the webinar, then that is the way to do so. I haven't really introduced David. I think most of you have been before and know him. David is genuinely one of the world's leading experts on employee share ownership. He wrote the Tolley's book on employee share schemes, and it's a pleasure and a privilege to have him with us to talk to us about this topic. Before I hand over to David, I would just like to thank our sponsors and members. This series of webinars is hosted by Zien's FS Club, and this is a list of the sponsors and members of the FS Club, without whose generosity and forbearance we wouldn't be able to run all of the webinars in our program, but we are able to run them. So a really big thank you to all of these sponsors and members, and then specifically around the Esops Centre, which has its own membership. This is a list of the members of the Esops Centre, again, without whose forbearance we wouldn't be able to do all of this. This is a detailed technical topic today. There are a lot of slides. The slides are available as a PDF both through GoToWebinar if you want to use the buttons, and on the website if you want to pull the slides down afterwards. So don't feel you need to sit making loads and loads of notes of what you're seeing on the slides. Those will all be available for you afterwards. And again, we're grateful to David for letting us have all of that material to use. So without further ado, I will hand over to David, who's going to talk to you about dynamic case studies into share valuation for employee share schemes. David, the floor is yours.
Well, thank you, Ian. Very pleased to be here again, and thank you to our sponsors, both for the Esops Centre and for the FS Club. I echo those sentiments. So my name is David Craddock. I'm from David Craddock Consultancy Services, and we're specialists in employee share ownership, reward management, management buyout, share valuation, and investment education. They're the divisions that we have within our business. But today we're going to focus upon share valuation. So let's go to the next slide. Right, okay, so initially I want to give a review of the key principles, and then having laid the groundwork of the key principles, I want to go into multiple examples. We've got 7 very interesting case study positions to examine, all drawn from my own case files, and I've got lots of other consultancy points to share with you along the way. So the meaning of market value, that seems to be pretty key to understanding how share valuation operates, whether it's with employee share schemes or otherwise. So the underlying principle is that we have this concept which is called statutory open market value. That is the basis of valuation in accordance with the relevant taxes legislation, the Taxation of Chargeable Gains Act 1992, section 272, in relation to any assets. And that, of course, includes shares. And it states the price which those assets might reasonably be expected to fetch on a sale in the open market is the basis for value. We then, of course, have references within the taxes legislation to market value. In essence, it is the same as statutory open market value, and it is the same also as actual market value. We do, of course, have this concept of restricted market value as well, and unrestricted market value. Restricted market value, again, is the same as actual market value. It is actually the market value which is assessed to be the market value on the basis of all the restrictions which are in place actually being in place. So actual market value is also restricted market value. So although we have all these terms which I've displayed on this slide, they all mean the same except for unrestricted market value. And unrestricted market value is a hypothetical position. Unrestricted market value is the market value assuming that the restrictions which empirically are in place are not empirically in place, and it's required for purposes of a particular section of the Taxes Acts, Part 7 of Income Tax Earnings and Pensions Act 2003, the part which relates to employment-related securities, specifically in relation to restricted securities, Chapter 2 within that part. There's another webinar I do on that, which I've done for the Financial Services Club. You can go back into the archives if you want to study that. But today we're going to be looking at the application of market value as statutory open market value as actual market value. Let's go to the next slide. So we're dealing here with SMEs. If you're working with a quoted company, you extract the value from a recognized stock exchange. But when you're working with a private unquoted company, what we colloquially refer to as an SME, a small and medium-sized company or small or medium-sized enterprise, we're needing to actually construct a value on the basis of what is required by the Taxes Acts. And here I've referred to Section 273, which talks about the information which is expected to be available to the parties in the sale for UK tax purposes when you're actually constructing a share valuation for shares within a private unquoted SME business. And it says this: the requirement is that there is available to any prospective purchaser of the asset in question all the information which a prudent prospective purchaser of the asset might reasonably require if he were proposing to purchase it from a willing vendor by private treaty and at arm's length. So two really important principles that come out of that. Firstly, those latter words, at arm's length, okay? A bargain at arm's length. So it's not one that's not at arm's length, it's one which is specifically at arm's length. And then, of course, this concept of the willing vendor. And indeed, when we're working with share valuation, we're talking about the hypothetical situation. This is what is required by the legislation, an understanding of what would be a hypothetical situation of a willing seller coming together with a willing buyer at arm's length with knowledge of the facts of the case in order to come to a deal. So let's go to the next slide. So here we have Lionel deceased. It went all the way through to the House of Lords during the period from 1968 to 1971. It is the lead case on share valuation in the United Kingdom. And it talks very specifically about the hypothetical sale between a hypothetical willing vendor, who would not necessarily be a director, and a hypothetical willing purchaser on the hypothesis, and this is the hypothesis, that no one is excluded from buying, and that the purchaser would be registered as the holder of his shares, but would then hold them subject to the Articles of Association of the company, including restriction and transfer. So in that context, the Articles of Association is pivotal to understanding how this hypothesis works. The parties who are available for entry into the transaction must assume to be very wide indeed. Remember that it talks about excluding no one, and that's why it's very, very wide indeed. And furthermore, the restrictions contained within the Articles of Association must be taken into account in the formulation of the judgment. And it is so very often the case that when a case actually reaches the courts ask first and foremost, what do the articles say? That's the first point of reference in my experience. So the application of this case to Section 270, that's what we're talking about. We're talking about the application of this case law to the statute, to interpret the statute for best practice. Section 272 is the statute, and that determines the tax value for purposes of capital gains tax. Typically, there is a need for a market in the shares to facilitate the position. When you talk to HMRC, as we do through the Worked Examples group, for which I am the technical advisor and secretary, point which they bring up time and time again is where is the market for the shares? That's what they're first and foremost interested in. A factor which appears to be the start point, therefore, for their deliberations. However, for a tax value to prevail, as opposed to simply a contractual value which doesn't have tax status, the capital gains tax treatment requires a transaction position that applies to an anonymous person with no special attributes other than, one, they want to buy. Yes, they've expressed the desire to buy. Secondly, that they have the resources to buy. So it's not just fictitious words. They do actually have the resources to buy. And also that they are a prudent person. So they bring some element of wisdom and prudence to the negotiations. So by properly applying this criteria, the transaction cannot apply specifically to a category of person, say, for example, to employees only or to directors only. It is exactly what it says in Lionel in that phrase that I've taken from it. It included at the top of that slide that no one is excluded. And in my commentary, that it is a very, very wide group of people indeed, essentially anybody in the world, as long as they meet that criteria of wanting to buy, have the resources to buy, and they are a prudent person. So let's go to the next slide. So look, this is a summary of the principles which we're going to apply during these case studies which I've prepared for you. The summary of the key assumptions that emerge from the case law are as follows. One, the transaction, okay, the parties to the transaction, that's the seller and the buyer, although they're both assumed to be hypothetical, they are very definitely assumed to be willing. They assume to have the characteristic of a willing buyer and a willing seller. Two, in essence, it must be assumed that anybody from anywhere in the world could offer themselves as a potential buyer and make a bid for the asset. Three, the application of the principles is predicated on the assumption that all the preparations for the sale have been made in advance. So these are prudent people, they're wise people, they've prepared for the negotiation at arm's length. Four, the best price must be assumed to be the best price that the buyer would be prepared to pay rather than the price that the seller will be prepared to ask. So we've all heard of people who say they can't sell their houses. Well, of course they can. Of course they can sell their houses if they're prepared to accept the price that the buyer is prepared to pay. And so it's the price that the buyer is prepared to pay which is paramount in determining what is the best price and the assumption that we make as to what is the best price. Five, the valuation must always give due recognition to market comparisons. And within that analysis, any special purchase arrangements of significance. I'm going to demonstrate to you how we work with market comparisons in determining value multiples. And I've also got a really powerful case study taken from our case files on special purchase arrangements. You'll be very, very interested indeed to see how that works in accordance with the appropriate case law. Six, the sale is hypothetical. I emphasize that it's the transaction which is hypothetical, but the economics of the environment in which the sale is taking place is not hypothetical at all. It's very, very real. So if there's a downturn in the economy, we take that into account. If there's a boom in the economy, we take that into account, and anywhere in between. So yes, the sale is hypothetical, but the economic situation in which the sale takes place is by no means hypothetical. It's assumed to be very, very real indeed, and that's what anchors the hypothetical transaction into reality. You see that? It's very, very subtle, but very clever and powerful. And then seven, the valuation must be determined at the valuation date. So the valuation is at a particular photographic point in time. So if we're actually constructing a valuation retrospectively, we've got to go back to information that would have been available at that date. We can't use hindsight. We've got to effectively put ourselves in the position of where we would be on that date for the transaction. Next slide, please. Thank you. So we've got that statute, section 272. We've got that interpretation from Lionel, that lead case. There are many other cases as well, which I included in my last presentation on share valuation. Go back in the archives if you want to see that. What we've then got to do, of course, is to determine how we're going to apply Section 272 and Lionel. And this is where the surrogates come in. This is what I call them anyway. I call them the surrogate positions. They're surrogate positions which enable us to apply the statute. So the relevance of determining the appropriate basis for valuation arises from the requirement to establish this surrogate position for purposes of giving a practical expression to the principles which are set out in Section 272. Yeah, and so as a general rule of thumb, whichever basis produces the highest value will prevail for purposes of the company valuation. There are various exceptions to that rule of thumb, but as a general rule of thumb, this is the case. And those bases are the earnings basis, the net assets basis, the trading basis, share trading basis I'm talking about, not company trading, share trading, and the dividend basis. There's also the offer basis. If some party, preferably an external independent party, but it could be a management offer as well, comes in with an offer or a bid, and typically if it's an offer, it will trump all bases, whether lower or higher than the other bases. Although you do need to take into account what is the stage of the due diligence. Clearly, if it's reached a stage where all the due diligence is completed, or as happens on some occasions, and I have known, I had one just a couple of years ago, a company came in with a requirement for no due diligence, in which case the offer basis goes right to the top of the pile and it trumps whatever basis we've previously calculated. Next slide, please. Thank you. So case study number one. Gosh, this is exciting, isn't it? Case study number one, the earnings basis for whole company value. So we're starting here with a little bit of a vanilla situation. This is a real life case study taken from a manufacturing company which we've worked with for some 4 or 5 years. And what we're taking here is a sustainable profit position. The sustainable profit position is the profit position below which the company does not expect post-tax profits to fall over the course of the next 12 months. We take that sustainable profit position and we multiply it by the value multiple. The value multiple of it is, of course, derived from the price earnings ratios. So the sustainable profit position, we've there got profits going from 17 to 20, 2017 to 2020. 350,000 goes down to 260, but then we have a rising trend to 330. So when you've got a rising trend and the expectation is for that rising trend to continue, typically you would take the last full year's profits, and provided you're not that far into the year. So I've identified here that this was prepared on the 6th of May 2020, sitting at this very desk nonetheless. And so the year end is not that far away. The 31st of March 2020, not that far away. At that stage, it was latest estimate, and it's subsequently actually got enshrined into the accounts in that very number. So 330,000. The value multiple, we've taken 3 quoted companies. We've not weighted them in any way. We could if we wanted to, but we haven't. We've taken an average. To that average, we've applied a discount of 50% for lack of marketability of the shares. Remember, it's a private company. Taken 50% to halve 14.31 to 7.2. And then we've added a bid premium of 20% to take it to 8.59. The bid premium is introduced to recognize not that the company is expecting a bid, but that all numbers, whether it be share prices or PE ratios which are extracted from the stock exchange, are minority interest prices and therefore need to be grossed up to produce the position which can count as a whole company value. And there we multiply one by the other to get the whole company value. We compare it with the assets basis, which is less. So earnings basis 2.8 million compared with 1.5 for the assets basis, and therefore we go with the earnings basis. We then apply our minority interest discounts, which I'm going to give reference to later on in the talk. Okay, let's go to the next slide. Case study number 2. So this is where the assets basis wins. So here we've got a company which is a financial services company. Its income is tied to the position on the stock exchange at the point at which it bills, and that's why profits do move around over the course of the years. So we move there from 2017 to 2020, 415, 635 down to 425, back up to 450, and then in this current year they're anticipating zero. They're anticipating a zero position on profit or loss, essentially a break even. That's why I've included the word naught. So what have I done? I've taken an average of the last 3, including the zero for this projected year. I've taken 2 as historical and 1 year projected for the current year. multiply that average sustainable profits by the value multiple. That gives us the whole company value. Let's compare it here with the asset space. Well, the asset space is here is higher. Yes, even where we've allowed for a reduction in accordance with the revaluation of the property. So we go for the asset spaces, and then to the asset spaces, just as in case study 1, we apply the minority interest discounts, we apply the minority interest discounts here to the assets position. It is a net assets position. We don't discount the net assets for it being a private company. We take them exactly as they are, unless there's some concern about bad debts or valuation of property, as is the case here, and then we apply the minority interest discounts. Okay, next slide, case study 3, share trading basis. This is where we've got a minority interest price constructed on the basis of significant intellectual property. So look, annual losses, they're making losses. 2011, 2012, there's no value arising from an earnings basis. They're making losses. And so the question is, look, we're making losses, David. Why should there be value? Well, there might be value, and I'm going to explain to you why. Let's have a look at the asset basis. We get a little bit of a clue there. Despite making losses, they've not got accumulated net liabilities. Why? Because numerous investors have injected cash into the business to buy shares, to invest in this company, such as the promise that they see it coming good at a later day and producing value for them. So net assets does actually produce a value, 0.0041. But look, share trading basis, that's where the money's come from to get cash into the bank account and show forth on the balance sheet. Share trading basis, we've got a value of 0.354. Yeah, how has that arisen? That's because there is a value to the intellectual property. So I value the intellectual property on the basis of expected future cash flows and profit flows, trademarks, whatever I determine could realistically be given a market value. Remember, market value, not just what I call a mantelpiece value or a figurine value, a real true value. Yeah. And so I constructed the intellectual property to be worth 10.9 million. Yeah, pretty substantial when the company's making losses. Divide that by the number of shares. So little point I've shared with you here on this case study. There were what were called ordinary shares, A shares, and B shares. The A shares and the B shares were penny shares. What were called ordinary shares were £1 shares. So I applied a factor of 100 in order to convert all the shares into penny shares, and we were left with 307 million shares. So we divide 307 million shares into the 10.9 million pounds worth of intellectual property, and we get trading price of 0.0354. That's higher than the assets basis or the earnings basis. And so we go for the share trading basis. And HMRC want you to go for share trading anyway if there is share trading. They validate that through the market. Yes? Okay, let's go to case study number 4. Gosh, this is powerful stuff. We're now coming on to gross shares. Gross shares model using a reclassification linked to a freeze value. This is the most secure way. Those of you who ring me up and ask me all the time through my helpline about gross shares, this is the most secure way to introduce a gross share and ensure that your valuation is strong. So what we do here is we construct a whole company value along the lines we've discussed previously. Here we've got sustainable profit position of 50,000, value multiple of 8. Yes, value multiple we're talking about derived from the price earnings ratios. Price is value, earnings is profit, price earnings ratio. Value to profit, that's why we call it the value multiple. We multiply the 50,000 by the 8 and we've got a whole company value of 4 million. We freeze that. Whatever it is, the current share capital, yes, we're going to freeze that 4 million, that whole company value, into preference shares. Yeah, locked in through entries into the Articles of Association, amendments to the Articles of Association, locked in for all time, let's say, but certainly for the foreseeable future. So any future gain beyond that 4 million is going to attach to the ordinary shares, which at the time of the inception are not worth very much at all. They're worth no more than a very, very low nominal value. And we set the nominal value at say, typically 1,000th of a penny. So when you come to sell, let's say in 10 years' time, this company sells for 50 million. The first 4 million goes to preference shareholders. And then the remaining 46 million goes to the ordinary shareholders, depending upon what is the share of the ordinary shares. I've set up here A ordinary shares for the existing shareholders. They've got 50 500,000. For the B shareholders, which are the employee shareholders, they've got 100,000. It'll be in those proportions that gain above 4 million to the 50 million is shared. That is the most secure way of doing a growth share. Now, look, we might set the value at 0 in this example, but in reality, we would attach a little bit of value. We would attach a little bit of value to it. Why? Because we're respecting the hypothetical situation in section 272 and in lionel. And because of that hypothetical situation, we have to give respect to the buyer and the seller. Yeah, the buyer and the seller. And because of that, we've got to attract some value, whether it be small or large, to those growth shares. But typically, it's not very large at all. Okay. That is what's acceptable to HMRC. In my view, we could actually lock everything into those preference shares as we do, and that would be absolutely 100% secure from a technical interpretation of the legislation to ensure that those growth shares to start with have nothing. At the very most, they have very little, but we do need to demonstrate what that very little is. Let's go to the next slide, which is case study number 6. We're romping through these case studies. Let's look at case study number 6. Is it 6? Case study number 5. Sorry, Ian. Yes. So the growth shares model using a discounted profit flow analysis. This is where we're not using freeze position. So what we're using is essentially a discounted cash flow analysis converted into a discounted profit flow analysis. Into that discounted profit flow model, we need to construct, to start with, two factors. Firstly is the value multiple. We're using the derived price earnings ratio approach I've explained to you in the previous case studies. Let's say that's 10. We also construct a discount factor. Now you need to demonstrate to HMRC that discount factor is forensically constructed. And so I produce a construction which is based on composite elements. Typically, it can vary depending on the client, but in this case study, this is taken from a real life example, the risk-free rate of return based on research money markets, the risk premium for private equity investment, the risk premium for a small and non-diversified company, the risk premium for the share illiquidity of the company, all based on research position. I established there a position of 20. If you're working with a startup, you could typically start with a much higher percentage than 20, maybe even as high as 30 or 40. So we've got our value multiple, we've got our discount factor. We can then plug those into our discounted profit flow model. We project forward typically for 5 years on the basis of a meaningful growth rate for profit. We then reach year 5 in our model, and we apply the value multiple. Okay, that produces a whole company value at that point in time, projected forward 5 years hence, which we then discount back using the discount factor. In this case, it's the example of 20 to produce a net present value. Okay, that is our position to which we're going to apply the minority interest discounts. We're then on case study 6. This is special purchaser. Okay, we're making great progress, Ian. We'll cover all this material. Hope everybody's finding this interesting and powerful. Case study 6 is where you've got a special purchaser in the market. So the case study is what I said in that top line. Suppose you've got a company that's been valued by an expert share valuer at 20 million. This is a real life study. Okay, came to us back in 2018. And then suddenly a potential purchaser emerges who offers 60 million. What is the company's value? What are the principles which we apply in order to determine what is the company's value in those circumstances? Well, let's give reference to the international valuation standards to start with. The definition of a special purchaser: a particular buyer for whom a particular asset has special value because of the advantages arising from its ownership that would not be available to other buyers in the market. So this special purchase identified something really special about the asset, which is in this case the shares. And so the definition of special value is an amount that reflects particular attributes of an asset that are only of value to a special purchaser. So a special purchaser will be prepared to pay, therefore, a premium price. In our example, 60 million rather than 20. A premium price over and above the otherwise open market value in order to achieve its objective. So that's in accordance with the international valuation standards. The application of the hypothetical transaction, always we go back to the hypothetical transaction, section 272 and in lionel. the principle of the hypothetical transaction must be applied. The assumption will be that the hypothetical purchaser, this is really subtle but clever. The assumption, and it goes right to the heart of how to deal with a special purchaser situation. The assumption will be that the hypothetical purchaser will have to increase his offer for the asset to better the price of the special purchaser. That's the principle which we're applying. Okay, if that's true, then the premium price that the special purchaser is prepared to pay becomes an element in the determination of the statutory open market value. It comes into our section 272 calculation, and therefore it comes into our recognition of what is actual market value for purposes of the share valuation analysis. Now, Lionel has something very specific to say about this type of situation, and it came out on its travels its journey up to the House of Lords at the stop-off point of the Court of Appeal in 1969. And this is the position which HMRC rely on, in my experience of special purchase situations. HMRC consistently rely upon this interpretation that comes from Lionel, that the special purchaser's position will be recognised as contributing to the Section 272 position, and therefore the share valuation, if the following criteria is met. One, the special purchaser is offering to buy the shares. Secondly, the special purchaser is financially able to buy the shares at the enhanced price. And thirdly, that fact is known to the market, that the other buyers know about it. And therefore, because they know about it, if they want to, they can adjust their offer accordingly. And so the courts will require clear proof of those factors prevailing before weight is given to the decision that they make. But that is the basis on which they will make their decision. Let's go to case study number 7. Right, we're doing well, just 2 minutes after 12:30, I'm nearly there. So this is the distinction between equity value and enterprise value. You hear that talked about a lot in share valuation. It's written about a lot in Taxation Magazine and Tax Journal and various other economics magazines. The Economist, in fact, they talk about equity value and enterprise value all the time, as does Investors Chronicle. This is the point about equity value and enterprise value. They offer a different viewpoint on valuation. Each offers a different viewpoint on valuation, and it helps investors make their decision. It gives them two separate tools to understand the company from a valuation perspective. The equity value focuses on the share value, while the enterprise value focuses on the overall value of the business. And let me just demonstrate this. But remember that the equity value is used by stock market investors all the time, potential buyers of controlling interest. What is the share value, they will say. The enterprise value reveals how the business is funded, partly by shares. Capital comes in through share purchases and share trading, and partly through debt. So I've illustrated it. I've sort of illustrated it through a little case study here on this balance sheet. Equity value, gross assets, cash, liabilities equals net assets, reflected in the share capital, 70 each side. That's the equity value. Okay, that's your classic balance sheet. Just rearrange the balance sheet a little bit, and you've got gross assets at 100, represented in share capital, plus debt, which is the liabilities, less the cash is the enterprise value. So coming down, I've showed there the mathematics of how that all works. And at the bottom in blue, I've said that the enterprise value is the equity value plus the debt value, and therefore it indicates the source of funding for the business. The gross assets and the goodwill on the other side is the application of those funds. And therefore, you can see how potential investors use this distinction between equity value and enterprise value to give two separate viewpoints on the business. Okay, let's go to the next slide, which I'm not going to go into much detail on this, or indeed the next slide, Ian, which is the level of discounts. But the number of questions I get through my helpline and through clients, new or old, about discounts. If I got £1 for every question I was asked about discounts, I'd be a multi-millionaire. But anyway, there's the discounts for you to look at in your own time. Just to tidy up now at the end, let's go on to the final 2 slides, final tips for share valuation. So when I sat down at the weekend and thought about what am I going to do my case studies on, well, I picked out those 7 case studies for you. Could have done it on lots of other things as well. So here are just a few tips to go through as we come to the end of the webinar. 1, the predominance of share trading. HMRC will always give emphasis to any trading in the shares, although they can in certain circumstances be overridden. if any basis, say typically earnings basis, can demonstrate a higher value. Every case is different. And fundamentally, HMRC are interested in the market, but earnings basis can override a share trading position, particularly if there's a lapse of time since the last trade. Secondly, offer basis. Talking here about takeovers. A genuine offer trumps all other bases, whether it's higher or lower, although it does depend upon the state of the due diligence at the time as an influencing factor. 3, the one value for the same transaction. There has to be only one value for both the seller and the purchaser. Yeah, there can't be different values for the same transaction for different parties. 4, rights and restrictions of the seller of the transfer. When setting a value, always examine the rights and restrictions of the shares in the hands of the seller, who is, of course, the transferor before the sale or the transfer. Essentially, you're looking at where the shares come from to determine what the value should be set at. The already determined values. Okay, so if you've got a tranche of shares which has attracted a transaction, HMRC will look to that transaction, potentially even to extend it across into other classes. Purchase of shares by a majority shareholder. A majority shareholder will normally not buy additional shares at a minority price. Okay, it could actually be a related property transaction, in which case inheritance tax rules would forbid it anyway. But do remember that principle; it comes up again and again and again. Let's go to the final slide. Articles of Association. Recognize that the Articles of Association is part of the hypothetical situation. HMRC, in my experience, do recognize that. Recognize also that the articles are part, well, the articles do represent, they are the constitution of the company, and so their integrity should be respected in all dealings relating to shares. Remember, the articles deals with the internal operations of the company, and share dealing is part of the internal operations of the company. 8, there's 3 more points now. The influence of voting rights in different classes of shares. If you have different classes of shares, talking here about minority interest shareholders, then potentially, if one class has got voting rights, the other don't have voting rights, HMRC will recognise that. In my experience, most times they will recognise that. And they will recognise a different class as an element in establishing a different value. I had a lead case through my own practice just 3 years ago, where that lay at the very heart of winning that case. It was a major, major triumph. 9 is the treatment of excess cash. You perform your earnings basis, but earnings basis is predicated upon the assumption of the required working capital for the business. Where you've got excess cash, you add that on to the earnings basis, okay, to determine the value. And the final point is internal market. You need to ensure there's some congruence between the basis that you use to determine your purchase prices and the basis that you use to determine your sale prices. Okay, and typically you'll look to the last sale price in order to determine, let's say, the price that you fix for your next grant of option, or at least it'll provide the basis for the work that you do on determining your next option price. Yeah, there's also a point about internal market which I must bring out because it comes up again and again and again. I get asked about it a lot, particularly where there are employee share trusts. And this is a point about interaction between tax law and trust law. Trustees should not be purchasing above market value because it's a breach of trust. Okay, so that's just an interesting point to bear in mind when you're working with trustees. And credible integrity trustees will never do that. Okay, thanks ever so much. Whatever help I can be, I'm here and available through my my practice. But at this point, I'm here to be helpful through answering whatever questions you've got for me. Thank you very much indeed.
David, thank you very much. That was terrific, and I think it did answer the questions that came in last time. But we do have a few questions that have come in during your talk. I think 1 or 2 of them have almost been answered. So if we can try to answer these questions fairly pithily.
I will. Bring them on.
First one from Susan. You mentioned international valuation standards. Do they apply worldwide in every country, or are there places where this wouldn't apply?
Yes, and any credible developed jurisdiction will recognise the international valuation standards. That they are very well constructed, very well researched. They're prepared on the basis of consensus across all the Western countries and the developed Commonwealth countries and others besides. So yes, thank you. Great question.
Great. Well, we have a question from Chris, who's also just chipped in and said, yeah. So I think he agreed that you probably answered his question as you were going along. But I have a sort of variant on the question because he wanted to know about the valuation basis for growth shares. geared instruments of that kind. And I was wondering, just from my own experience of looking at option pricing theory and the use of the Black-Scholes model as a method for looking at shares where you can't use the sort of what I would consider to be the standard tradable bases, and yet you have to do something. Do you have examples of HMRC recognizing those sorts of methods, or should we be leaving those out for the time being?
Well, I've never made a submission for a share valuation on the basis of Black-Scholes. I do use Black-Scholes all the time for share-based payment accounting. I'm going to be preparing one immediately after we've had this webinar. The point about Black-Scholes is that Black-Scholes was never constructed. It was never designed for employee share schemes. It's a surrogate position which is used for share-based payment accounting. Because we have to have something to apply the international standard on share-based payments. But when it comes to share valuation, I would gear away from Black-Scholes. One, HMRC don't like it, and I have that on record. HMRC do not like Black-Scholes. HMRC want to see something as simple as possible. You know, I've shared with you my reclassification and value freeze model. I've shared with you my discounted cash flow model. Sometimes they're prepared to accept a current value with a heavy discount. They want to see something really, really simple. If you send Black-Scholes in to HMRC, it's going to get elevated up to senior levels. You're going to get loads more questions. You're going to get a long delay in getting your agreement. And in my view, I go as far as to say I do believe that it is technically flawed in providing a basis for a gross shares valuation.
That's really helpful. Thank you. One more question. Again, I think you'll be able to come up with a fairly pithy answer. This is from Annette, who would like to know, you were talking about using PE ratio comparators in one of the valuations. How do you choose the peers for a PE ratio?
Okay, yes. So you're looking for companies that are operating in a same or similar trade. That's the first port of call, a same or similar trade. Typically, the companies that you pick out are going to be significantly larger and significantly more diversified than your client company, but you're looking for some element within there. Clearly, the application of the discounts, not the minority discounts I'm talking about the discounts which get you from quoted company to private company level. They will account for the fact that company is much more diversified. But same or similar trade. Now, it might well be that there isn't same or similar trade. So you say to the client, well, what about your customers? What about your customers? Tell us who your customers are. And that might provide the basis for the PE. Ideally, you want to get a basket of 6. Okay, sometimes it's 3, sometimes it's 1 or 2, but ideally you want to get I aim for a basket of 6, ideally. So okay, supposing there's nobody in same or similar trade in the quoted market, supposing that your customers aren't quoted, you would look for the different elements within your trade and piece together a P ratio on the basis of selected companies accordingly. Hope that answers your question, Annette. Thanks for that.
No, that's terrific, David. We are out of time. I can only thank you again for a terrific webinar. I found that really interesting and really helpful, particularly building on the earlier webinar where you went through the technical aspects of the evaluations. And I do encourage people, if you haven't seen some of the early webinars and you've got the time or the inclination to have a look at them, the slides are up there and available if you want to just look through the slides. Recordings of the webinars are up there on the website as well if you want to look at the recordings. The emails are pipping in through the question box with people thanking you, saying it was really interesting and really helpful. So that's echoing my thoughts. I just have a few more words to say before we sign off. First of all, once again, to thank our members and sponsors from the Esops Centre and from the FS Club for their generosity and forbearance in sponsoring this webinar program. We really are very grateful to you. We wouldn't be able to do it without your help. And people clearly are finding these things very very useful and enjoyable. So thanks to all of you. There are a myriad of resources available, not just the webinars and the program. For the Esops Centre, we have the website and Newspad, which is very popular amongst the Esops Centre members and is available for people to read if it is a matter of interest to you, regardless of whether you're a member or not. We also have FS Club bulletins, which cover all manner of topics, not just employee share ownership, but we do have bulletins on employee share ownership as well. These are all available through the FS Club part of our website, and you can subscribe to whichever bulletins you fancy and unsubscribe if you start to feel inundated. We get more people subscribing than unsubscribing, and we don't get very many unsubscribes. We have lots of forthcoming webinars. New webinars are going up all of the time. We're doing 3 or 4 a week, pretty much every week. At the moment, we imagine that that is going to continue for the foreseeable future. So tomorrow, VR, AR, or MR, is the virtual world more real than we think? On Thursday, how to develop an ecosystem for fintechs. Then on Monday, we have going paperless e-signatures. On Tuesday, what does banking stand for? That sounds very generic indeed about banking. And on Wednesday next week, long lessons, can the religions of the book teach us anything about modern finance? We've said thank you to the audience. We've said thank you to the sponsors. We do now need to say thank you to you, David. Fans of these webinars know that I try to choose a musical instrument with which to say thank you each time. I'm running out of musical instruments, folks, but I just had a really mad idea. It's a really bad pun, I know. You have seen the use of the 4-string guitar before, but I thought this time, because it was case studies, I'd leave it in the case and use the gong hitter and see what it sounds like. So this is a way of thanking David. Okay. Sounds quite nice, doesn't it?
Thank you, Ian. Yes, thank you.
Maybe that's a one-off. Maybe we won't be doing that one again.
Case studies, I like that.
Yes. Genuinely, thank you very much indeed, and thanks to the audience. We'll see you all again next time. Bye, everybody.
Thank you.